4:15 a.m. Eastern Standard Time. New York is asleep. London is barely brewing its first coffee. The Asian markets have just gone dark. This is what we call the liquidity vacuum, a 60-minute window where the global financial system is most vulnerable. A ghost town. And precisely at 4:16 a.m., a sell order hits the CME Group servers. Not just a trade, but a weapon. Billions of dollars in paper-silver contracts are dumped into the void in milliseconds. The algorithms scream. The bid stack evaporates. The price crashes from $120 to $83 before a human trader can even blink. On your screen, this looks like a panic. It looks like a liquidation event, where millions of investors decided to abandon ship simultaneously. The financial news networks are already typing up their headlines. The bubble bursts. Cash is king. Silver is dead. But they are looking at the crime scene from the wrong angle. They are staring at the blood on the floor, while ignoring the man walking out the back door with the safe. Because while the digital price was being murdered on the screen, something impossible was happening in the physical vaults. At the exact moment the price hit rock bottom, the outflow requests for physical bars didn't stop. They accelerated. Someone was standing at the bottom of that waterfall with a bucket, catching every single drop of blood you spilled. The sun rose over New York City on Monday, February 2nd, but for millions of investors, it might as well have been the middle of the night. You woke up, you reached for your phone, and you saw the carnage before your eyes could even focus. It was a sea of red, a digital slaughterhouse. Gold was down 13%, lurching violently around $4,700. But silver had been taken out back and executed, down 36%, trading at $83 an ounce. Just 72 hours prior, we were discussing triple digits. We were modeling the breakout of the century, and in the span of a single Asian trading session, that future was erased. The financial media wasted no time dancing on the grave. If you turned on CNBC at 8 a.m., you saw the victory laps. The headlines were flashing like neon signs in a casino. The bubble has burst. Commodities are dead. Cash is king. They rolled out the experts at the same suits who missed the inflation spike of 24 and the banking crisis of 25. And they all sang from the same hymn sheet. They told you that sanity had returned to the markets. They told you that the appointment of Kevin Warsh had restored faith in the dollar, and that the smart money was dumping hard assets to flood back into treasuries. It was a coordinated symphony of panic designed to make you feel stupid, designed to make you feel like the last dinosaur on Earth holding a rock while the rest of the world moved into the digital utopia of high-interest fiat. But while the talking heads were celebrating the return of the dollar, something very strange was happening on the streets, something that the algorithms in New York could not see, and the pundits in the studio refused to acknowledge. This is where the story diverges. This is where the matrix glitches. Because if you believed the screen, you assumed that the world was flooded with silver. A 36% price crash implies a massive surplus. It implies that everyone is selling and nobody is buying. It implies that dealers are drowning in inventory they cannot move. That is basic economics 101. Supply exceeds demand, price falls. So let us test that theory. Let us step away from the glowing screens and walk into the real world. I want you to imagine walking into your local coin shop right now, or logging onto the biggest bullion dealer websites in the world. The spot price is $83. So logically, you should be able to hand over $85 and walk out with an ounce of silver. But try it. Go ahead. Make the call. You will find the doors are locked, or the shelves are bare. If you are lucky enough to get a dealer on the phone and you ask for a monster box of Eagles at spot price, he will not sell it to you. He will laugh at you. He will tell you that his inventory was wiped out 3 hours ago. He will tell you that the mints have stopped taking orders. And then, he will drop the hammer. He will say, sure, I can find you some metal, but the price is not $83. The price is $120. Welcome to the disconnect. Welcome to the spread. This is the moment the paper market and the physical market filed for divorce. We are staring at a phantom price. The $83 you see on the chart is a lie. It is a number generated by high-frequency trading algorithms, exchanging paper contracts that will never be settled in metal. It is a ghost. In the real world, where atoms have weight and supply chains have limits, silver has become unobtainium. It does not exist at the price the television says it does. This brings us to a terrifying realization about the information you consume. Most people are content to look at the ticker tape and believe what they are told. They see red, they sell. They see green, they buy. They are the liquidity that feeds the machine. But you are not most people. You are still here deep in the weeds of a market autopsy because you sense that the official narrative is a fabrication. You are looking for the signal hidden inside the noise. That is the only reason this channel exists. We are not here to entertain the masses. We are here to document the crime scene for the few who are paying attention. If you want to be part of the minority that understands the mechanics of this theft, rather than being a victim of it, you should make sure you are connected to this investigation permanently. Because the discrepancy we are witnessing is not just a glitch. It is evidence of a crime. Think about the volume. Look at the charts again. During that crash, billions of dollars in silver contracts were sold. The volume bars were skyscrapers. The selling was relentless. But for every seller, there must be a buyer. That is the iron law of the market. You cannot sell into a void. Someone has to be on the other side of the trade taking the order. So ask yourself the detective's question. Who is buying? If the retail investors are panic selling because CNBC told them the world is ending and the pension funds are too slow to react, and the industrial users are sitting on their hands waiting for the bottom, then who stepped in? Who had the capital and the courage to absorb billions of dollars of selling pressure in a free fall? Who stood at the bottom of the waterfall with a bucket and caught every single drop of blood? This was not a random market event. Markets do not crash 36% in a straight line without a single bounce unless they are pushed. And they do not hit a hard floor and instantly vanish from physical inventory unless someone is sweeping the board. We are not looking at a market correction. We are looking at a transfer of ownership, a massive migration of wealth from the visible accounts of the public to the invisible vaults of the elite. The media wants you to focus on the price because the price scares you, but the price is a distraction. The real story is the volume. The real story is the flow of physical bars moving from the registered vaults, where you can see them, to the eligible and private vaults, where they disappear. They are counting on you being too terrified to ask where the metal went. They are banking on your capitulation. If you are the type of person who looks at that $83 price tag and feels fear, then you should probably close this video right now and sell what you have left. This investigation is not for you. But if you look at that price and you see a trap, if you look at the empty shelves and you see a heist, then you are ready for what comes next. Because to understand who stole your silver, we first have to understand exactly how they broke the lock. The weapon they used was not a hammer. It was an algorithm, and it was deployed with military precision. To understand the crime, you first have to examine the weapon found at the scene. In the case of the Monday morning crash, that weapon was not a physical bar of silver or a supply glut from a mining company. It was a derivative, a financial instrument known as a futures contract. This piece of paper is the key to the entire operation because it allows the largest players in the room to sell something they do not own, to drive down the price of something they intend to steal. Most people assume that the price of silver is discovered by two people shaking hands over a metal bar. That is a quaint idea that has not been true for 50 years. The price is discovered on a digital battlefield where leverage is the ammunition and information is the high ground. When the bullion banks decided to execute this raid, they did not dump physical metal onto the market. If they had done that, they would have lost their own inventory. Instead, they utilized the futures market to create a synthetic supply shock. Here is the mechanics of the theft. The banks know exactly where your pain point is because they act as the market makers. They have access to the order book. They can see the stop-loss orders of every retail trader and every hedge fund speculator. They know that if the price drops below $100, thousands of automatic sell orders will be triggered. They know that if it hits $90, margin calls will go out and forced liquidations will begin. So they wait. They wait for the liquidity vacuum when the Asian markets close and the European desks are still brewing coffee. In this thin atmosphere, it takes very little capital to move the price. They initiate a massive short sale, dumping thousands of paper contracts into the void. The price slips. It hits the first tripwire at $100. Your stop loss activates. Your broker automatically sells your position to protect you, but your sale adds to the downward pressure. The price falls to 95. This triggers the next wave of stops. It becomes a cascading liquidation event, a domino effect that feeds on itself. The banks do not have to push the price all the way down to $83. They only have to push the first domino. The algorithms and your own fear do the rest of the work. They weaponized your risk management protocols against you. This is what we call a stop-loss hunt. It is the extraction of liquidity from weak hands to strong hands, facilitated by the very structure of the exchange. But a mechanism is not enough. To execute a heist of this magnitude in broad daylight, you need a distraction. You need a cover story that makes the victim believe the robbery is actually a natural disaster. You need a narrative that explains why silver is suddenly worthless, so that the public does not ask questions while the vault is being emptied. Enter Kevin Warsh. The timing of his appointment and the media blitz surrounding it was not a coincidence. It was the smoke grenade thrown into the lobby to blind the security cameras. The narrative being pumped into your brain is simple and seductive. They are calling him the new Paul Volcker. They are painting a picture of a hard money sheriff who has ridden into town to restore discipline to the dollar. The story goes that he will raise rates, drain liquidity, and crush inflation once and for all. This narrative is lethal to precious metal sentiment, because if you believe the dollar is about to become strong and scarce, then you have no reason to hold gold or silver. The media knows this. The banks know this, so they amplified the signal. They used the Warsh announcement to justify the crash. When you looked at your screen and saw silver down 36%, your brain searched for a reason, and the media handed you one on a silver platter. They said the bubble has burst because the adults are back in charge. This psychological operation served two purposes. First, it provided a fundamental excuse for a technical manipulation. It made the $83 price seem rational rather than criminal. Second, and more importantly, it created the liquidity the whales needed to buy. You have to understand that when a whale wants to buy billions of dollars of silver, they cannot just click buy. If they did, the price would skyrocket to the moon before they filled 10% of their order. They need someone to sell to them. They need a massive wave of sellers to absorb their buy orders without spiking the price. By crashing the price and spreading the Warsh narrative, they terrified you into selling. You became the liquidity. You provided the inventory they needed to accumulate. This brings us to the most critical part of the operation, the asset migration. This is where the detective work turns into a whale watch. We need to track where the contracts went after you sold them. When a retail investor panic sells a futures contract, they are usually closing a long position. They take their loss in cash and walk away. But the entity on the other side of that trade, the entity that bought what you sold, is doing something very different. They are not speculating on the price bouncing back. They are using a mechanism called exchange for physical, or EFP. The bullion banks and the elite insiders are using the paper market to acquire the physical commodity. They buy the futures contract at the artificially suppressed price of $83. But instead of holding it and rolling it over to next month like a gambler, they immediately exercise the contract. They demand delivery. They convert the paper promise into a warrant for metal sitting in a warehouse. This is the ultimate arbitrage. They use the paper market to convince the world that silver is trash, and then they use the paper contracts to claim the silver as treasure. They are washing the asset. They are stripping the paper derivation away and taking the raw atoms. This is why the premiums on the street are exploding while the spot price crashes. The street price reflects the physical reality of the metal moving into strong hands, while the spot price reflects the paper delusion being discarded by weak hands. We are witnessing a decoupling event. The whales are exiting the casino. They are cashing out their chips not for fiat currency, but for the chandelier hanging above the poker table. They know that the Kevin Warsh narrative is mathematically impossible to sustain, which we will get to in a moment. But they are using the temporary belief in that narrative to secure their lifeboats. They are effectively trading a currency that is about to die for the only asset that has survived every currency death in history. And they are getting you to subsidize the trade by selling to them at a discount. The terrifying part of this transfer is the silence. There are no press releases announcing that JP Morgan or the Central Bank of China just took delivery of another 500 tons. There are only obscure data points in the warehouse reports, little footnotes that show metal moving from the registered category, which is available for sale, to the eligible category, which is private storage. This migration is a one-way street. Once the metal crosses that line, it effectively vanishes from the global supply. It enters the shadow vaults. These are the private allocated accounts, where the rules of the public market do not apply. It is the black hole of the financial system. And right now, that black hole is expanding at a rate we have never seen before. The flow of metal is torrential. It is a run on the bank, but the bank is not cash. It is commodities. The giants have positioned themselves. They have set the trap, sprung it, and are now collecting the harvest. They have successfully convinced the world that the building is not on fire, while they quietly remove all the fire extinguishers and lock them in their private bunker. They have swapped their paper liability for your physical asset, and they did it while you were cheering for the new sheriff in town. But if the physical metal is disappearing into private vaults at this speed, what happens when the paper market realizes there is nothing left to deliver? What happens when the next person stands for delivery and the vault manager has to admit that the cupboard is bare? The smoke from the crash has cleared, but the footprints at the scene tell a very different story than the headlines. We are continuing our whale watch because the beast has left a trail that no algorithm can erase. It is the trail of inventory depletion. To see it, we have to crack open the daily warehouse reports from the COMEX. These are the boring spreadsheets that Wall Street analysts usually ignore because they are too busy looking at price targets. But for us, this is the flight recorder. Look at the category marked registered. This is the silver that is fully warranted and available for immediate delivery against a futures contract. This is the liquidity of the market. Now look at the trend line for the last 30 days. It is not just declining, it is plummeting. We are seeing a pattern of withdrawals that defies the laws of a bear market. Typically, when prices crash, inventory builds up because nobody wants to buy a falling knife. But here, as the price collapsed from $120 down to $83, the registered inventory fell by 4 million ounces. Think about the logic of that. Who removes 4 million ounces of silver from the exchange when the price is crashing? You only do that if you do not trust the exchange to have the metal tomorrow. You only do that if you believe the $83 price is a gift from the gods, and you want to secure the goods before the store realizes they made a pricing error. This is the asset migration in real time. The metal is moving from the public display case into the private safe. But it gets darker. Tracking the metal from registered to eligible is one thing. Eligible just means it is still in the COMEX vault, but it is now privately owned and not for sale. The real metric of the heist is the net withdrawal column. This is the metal that leaves the building entirely. It gets loaded onto armored trucks and driven away. In the last 48 hours since the crash began, the physical loadout requests have spiked 300%. This is the equivalent of a bank run. If you saw a line of people stretching around the block, waiting to pull their cash out of a regional bank, you would know immediately that the bank is in trouble, regardless of what the stock price said. Well, the armored trucks lining up at the vaults in New York and London are that line of people. The whales are cashing out. They are draining the reservoir while telling you the dam is overflowing. Now, I want you to look at this chart right here. This is the debt to GDP ratio of the United States, and this red line is the interest expense on that debt. I want you to be the judge here, because this is where the rubber meets the road. Kevin Warsh says he is going to pull a Paul Volcker. He says he is going to raise rates and keep them high to save the dollar. But look at the math. In 1980, Volcker could raise rates to 20% because the national debt was less than $1 trillion. It was a rounding error. Today, the debt is $38 trillion. If Warsh keeps rates at 5%, just 5%, not 20%, the interest payments on the debt will hit $2 trillion a year. That is more than the government collects in income tax. It is mathematically impossible. The U.S. government would have to borrow more money just to pay the interest on the money it already borrowed. That is the definition of a Ponzi scheme. And Ponzi schemes do not survive high interest rates. They collapse. So here's the question I want you to answer in the comments right now. Look at these two lines crossing on the chart. The debt line going vertical and the interest rate line that Warsh claims he will hold steady. Do you believe the United States government will voluntarily choose to default on its debt and collapse the global economy just to save the dollar? Or do you believe they will eventually pivot, turn the printers back on, and inflate the debt away, destroying the currency in the process? It is a binary choice. Default or hyperinflation. There is no third door. Tell me which button you think they will push and why. Because your entire financial future depends on being on the right side of that bet. The whales have already made their bet. That is why they are taking delivery. They know Warsh is bluffing. They know he is crashing the price to create a deflationary scare so he can buy time. But they also know he cannot hold this pose for long. The moment the bond market cracks, the moment the interest payments become suffocating, he will fold. He will print. And when he prints, the price of silver will not just recover, it will teleport. We are watching a game of chicken between the Federal Reserve and the bond market. The Fed is revving its engine, pretending it is willing to drive off the cliff of austerity. But the bond market knows the Fed has no parachute. The whales are simply getting out of the car before it goes over the edge. They are swapping their dollars for silver, because silver cannot go bankrupt. Silver does not have a counterparty risk. It is the only asset that is not someone else's liability. But this migration is not just happening in New York. If we zoom out, if we look at the global map, we see that the drain is coordinated. It is happening in Shanghai. It is happening in London. It is happening in Singapore. The West is selling paper, and the East is taking delivery. This brings us to the geopolitical dimension of the heist. Because while American investors are being shaken out of their positions by a scary narrative and a manipulated chart, foreign governments are standing on the other side of the trade with open arms. They are not afraid of Kevin Warsh. They are not afraid of the Federal Reserve. They are afraid of holding US dollars when the music stops. We need to follow the metal as it leaves the Western financial system entirely. We need to trace it to the new power centers that are rising in the East. Because what is happening there is not just a trade. It is a declaration of independence. The investigation into the disappearing 4 million ounces leads us away from the charts and across the ocean, because money is like water. It flows to where it is treated best. And right now, Western capital markets are treating silver like toxic waste, while the East treats it like a strategic reserve. We are witnessing Gresham's law operating on a planetary scale. This economic principle states that bad money drives out good money. In the 17th century, this meant that if a government debased their coins by mixing in copper, people would spend the copper coins and hoard the gold ones. Today, the bad money is the US dollar and the paper derivative contracts attached to it. The good money is the physical metal. While American investors are dumping their paper contracts in a panic over the Kevin Warsh announcement, the Shanghai Gold Exchange is engaged in a buying frenzy. The premiums in Shanghai have blown out to historic highs relative to London and New York. This arbitrage gap is the smoking gun of the asset migration. It proves that the West is suppressing the price to liquidate its position, while the East is utilizing that suppressed price to drain the West of its physical inventory. China, India, and the BRICS nations are not looking at the debt to GDP chart of the United States and seeing a partner. They are seeing a counterparty that is about to default. They are trading their trade surplus dollars, which are effectively IOU notes from a bankrupt treasury, for physical commodities that have no liability attached. They are exchanging a promise for an atom. This is not a conspiracy theory. It is a trade balance reality. Every ounce of silver that leaves the COMEX registered vault does not just disappear into thin air. It gets loaded onto a pallet and shipped to a jurisdiction that understands the endgame of the fiat currency experiment. But the destination of this migration is not always a government reserve. A massive percentage of this wealth transfer is flowing into what we call the shadow vaults. These are the private non-bank storage facilities located in sovereign free ports like Singapore, Zurich, and the Cayman Islands. When a billionaire or a sovereign wealth fund takes delivery of silver, they do not keep it in the banking system. They know the banking system is the risk. They move it into allocated storage in a private jurisdiction. Once the metal enters these facilities, it vanishes from the visible global ledger. It is no longer reported as commercial inventory. It is no longer available for delivery. It effectively goes dark. It enters the black hole of private wealth preservation. This is why the data from Act 3 is so terrifying. The 4 million ounces that left the COMEX did not go to Apple to make iPhones, and it did not go to Tesla to make solar panels. It went into a private hole in the ground to wait out the collapse of the dollar. The whales are removing the chips from the table because they know the casino is about to catch fire. They are creating an artificial scarcity that will haunt the industrial world for the next decade. And this brings us to the supply side of the equation, which is the final nail in the coffin for the paper market. At $83 an ounce, the paper price has fallen below the all-in sustaining cost of production for a significant percentage of the world's primary silver mines. You cannot run a mine on a loss. You cannot pay for diesel labor explosives and environmental permits with promises. When the price stays below the cost of production, the mines do not produce more, they produce less. They high-grade their deposits, meaning they only mine the richest veins and leave the rest in the ground. Or they shut down operations entirely and go into care and maintenance. This creates the ultimate paradox of the Warsh Narrative. By crashing the price to fight inflation, the manipulators have destroyed the incentive to produce the commodity. They have severed the supply chain at the very moment demand is moving into the shadow vaults. We are facing a supply cliff. The existing above-ground stocks are being privatized and hidden, and the new underground supply is being economically strangled. Think about what this means for your daily life. Silver is not just a monetary metal. It is the most conductive element on Earth. It is in the circuit board of your phone. It is in the switch that turns on your lights. It is in the solar panels that are supposed to save the planet. If the whales lock up the inventory and the mines shut down, the price does not just go up, it goes vertical. We are not talking about inflation. We are talking about unavailability. We are talking about a world where the industrial supply chain grinds to a halt because the paper traders played games with the physical reality. The narrative managers in Washington want you to focus on the interest rate. They want you to argue about 25 basis points. But the real game is being played in the logistics network. The real game is the physical possession of the critical resources that run the modern world. The United States is selling its strategic assets to its geopolitical rivals at a discount, and it is calling it a victory against inflation. It is the equivalent of burning down your house to keep warm for one night. The trap has been set not just for the retail investor, but for the entire Western industrial base. The East has the metal, the private whales have the metal, and the public has the paper promise of a government drowning in $38 trillion of debt. The tension between these two realities, the paper illusion of abundance and the physical reality of scarcity, is reaching its breaking point. The spring has been compressed to its absolute limit. When it snaps back, it will not be a gentle correction. It will be a violent repricing of everything you thought you owned. The window to exchange your paper for metal is closing, not because the price is going up, but because the metal is going away. We are approaching the event horizon, where the two markets separate forever. Stop asking if it is a bull market or a bear market. Those are terms invented to keep you trading. They are binary labels for a finite game, where the objective is to end the quarter with more dollars than you started with. But the people moving 4 million ounces of silver out of the COMEX in the middle of a price collapse are not playing a finite game. They are playing an infinite game. In an infinite game, the objective is not to win the round. The objective is to keep playing. The objective is to ensure that you and your bloodline survive the collapse of the system that governs the round. When you look at the screen and see red candles, you are looking at the scoreboard of the finite game. You are seeing the score in dollars. But the whales, the central banks, and the dynastic families do not keep score in dollars. They know that dollars are just the chips used in the casino, and that the house can recall the chips or change the value of the chips at any moment. They keep score in ounces. They keep score in tons. They keep score in the percentage of the total global supply of strategic resources that they control. If you own 1% of the world's silver, it does not matter if the price is $83 or $800. You own 1% of the electrical conductivity of the future. You own a seat at the table of the new economy. The price is irrelevant because you are not planning to sell it back for fiat currency. You are holding it to dictate the terms of trade when the fiat currency fails. This is the difference between a trader and an owner. A trader rents an asset, hoping to sell it to a greater fool. An owner captures the asset to remove it from the game entirely. We are currently witnessing the bifurcation of the financial universe into two distinct dimensions. For the last 40 years, these dimensions overlapped. The paper price and the physical price were roughly the same, because there was enough trust in the system to believe that a paper contract was as good as gold. But that trust has evaporated. The dimensions are tearing apart. On one side, you have the paper dimension. This is where the masses live. This is where your 401k lives. It is a world of high-frequency trading leverage and digital illusions. In this world, silver is crashing. In this world, Kevin Warsh is a hero. In this world, debt is wealth. It is a simulation running on confidence. And when that confidence breaks, the simulation will simply be turned off. On the other side, you have the physical dimension. This is where the elites are migrating. This is the world of private vaults in Singapore and bonded warehouses in Zurich. In this world, silver is not crashing. It is vanishing. It is becoming unobtainium. In this world, debt is a liability, and possession is the only law that matters. The tragedy of the average investor is that they are staring at the paper dimension, trying to make sense of the physical dimension. They look at the spot price and say, "Silver is cheap. I will wait for it to go lower." They do not realize that the price is only low in the dimension where the metal does not exist. They are waiting to buy a ghost. By the time they realize that the physical metal has decoupled from the paper price, the door to the physical dimension will be locked. This crash is not a disaster. It is a final boarding call. It is the narrow gate that the Bible speaks of. Broad is the road that leads to destruction, and many enter through it. That is the road of selling your assets for cash because the television told you to be afraid. But narrow is the gate, and difficult is the road that leads to life, and only a few find it. That is the road of buying the asset that everyone else is despising. You have to understand that the window to convert your labor into honest money is closing, not because the price is going to infinity tomorrow, but because the liquidity is drying up today. The 4 million ounces that left the vault this week are never coming back. They have been removed from the velocity of money. They have been turned into generational concrete. We are standing on the deck of the Titanic, and the band is playing a tune called The Strong Dollar. The passengers are dancing. They are celebrating because the bar tab just got cheaper. But the smart money is quietly walking to the lifeboats. They are not running. They are not screaming. They are simply moving. They know that once the iceberg hits, the value of a seat on the lifeboat cannot be measured in cash. It is priceless. You are being presented with a choice that will define your financial legacy. You can stay in the ballroom and dance with the algorithms, or you can walk to the deck and secure your seat. To do that, you have to be willing to look stupid to the crowd. You have to be willing to buy when they sell. You have to be willing to hold an asset that pays no yield and has no counterparty. You have to be willing to be your own central bank. This is the verdict. The system is not broken. It is working exactly as designed. It is designed to strip assets from the impatient and deliver them to the patient. It is designed to use volatility to shake the weak hands so that the strong hands can accumulate cheaper. The drop to $83 is the mechanism of transfer. It is the vacuum cleaner sucking up the last loose ounces before the vault door slams shut. Do not let the noise on the screen distract you from the signal in the vault. The game is not about how many dollars you can get for your silver. The game is about how much silver you can get for your dollars before the dollars revert to their intrinsic value of zero. The infinite game is about survival, and in the history of financial collapses, no one has ever regretted holding too much gold or too much silver. They only regretted holding too much paper. We are living through a history book chapter that has not been written yet. 50 years from now, your grandchildren might ask you what you did when the great decoupling happened. They will ask you if you saw the signs. They will ask you if you followed the herd off the cliff, or if you stood your ground and built the foundation of their freedom. This is not about speculation. This is about protection. The hours you worked, the sacrifices you made, the time you spent away from your family to earn that money, all of that stored energy is sitting in a currency that is melting like an ice cube in the sun. Converting it into physical independence is the only way to freeze that time and transport it to the future. We are watching the greatest wealth transfer in human history take place in complete silence. The media will not cover it until it is too late. The banks will not warn you because they are the ones on the other side of the trade. You are on your own, but you are not alone. There is a remnant of people who see the same data you see and are coming to the same conclusion. If you are ready to stop playing their finite game of paper profits and start playing the infinite game of generational survival, then you need to stay close to this investigation. We are going to keep tracking the flow until the last ounce leaves the vault. Subscribe to the channel not to watch, but to prepare. This system does not stop, and neither do we. Price is what you pay with money they print from thin air. Value is what you hold when the machine breaks down. Do not sell your heritage for an illusion. Stack harder.